This is Module D, the costs of capital. Before we start talking about costs of capital, we need to reintroduce the idea of risk and discuss its relationship with rates of return. For any rate of return which an investor demands, whether it's an equity investor or a lender, there's going to be a certain amount of uncertainty that investor faces, and they're going to ask for a higher return if they face more uncertainty or more risk. The relationship that I've shown you before is that the cost of debt, the percent required by lenders, is going to be lower than the cost of common equity. KE is going to be greater than KD because equity investors face more uncertainty or more risk than lenders. Lenders have contracts written around the debt, which give them a guaranteed payout and a schedule for the payout. The equity holders really have no guarantees at all unless they are preferred equity holders, in which case they get a certain amount less uncertainty. So the relationship is that KD, the cost of debt, is going to be the lowest percentage because it faces the least risk. And KE, the cost of common equity, is going to be the highest percentage because it faces the highest amount of risk. All of these are going to be greater than what's called the risk-free rate. So I'm going to introduce a new term to you now. RF is going to be the abbreviation I will use when I'm talking about what's called the risk-free rate. The risk-free rate is the baseline rate of lending which is used in finance computations, and it represents the rate of return which is demanded on a riskless investment. In other words, an investment that has no uncertainty attached to it. Now, in reality, everything has a certain amount of uncertainty, but the closest that we get in our economy is going to be U.S. government bonds. So when we're talking about the risk-free rate, I'm going to be talking about the return demanded on U.S. government bonds. Let's say, for example, that government bonds are yielding 3% currently. If that's the case, then our risk-free rate would be 3%. And the cost of debt, the cost of preferred equity, and the cost of common equity are each going to be higher than that. Each of those costs is going to include a premium for that additional risk. In other words, somebody who's buying a corporate bond is facing more risk than they would if they were buying a government bond, and for that reason they'll demand an amount above that risk-free rate, a risk premium. The holder of preferred equity would be facing still more risk, so they would ask for a larger risk premium. And the common equity holder would be asking for the highest return and would have the largest risk premium associated with their investment. If the risk-free rate is 3% and the cost of debt for a company is 6%, then we'd be looking at a 3% risk premium on their debt. If the cost of common equity is 17% and the risk-free rate is 3%, we'd be looking at a 14% risk premium on their common equity. Another thought to introduce is this, and that is that the risk-free rate is always going to be greater than inflation. This is because investors, even if they're investing in something extremely conservative, are going to be requiring a certain amount of return just to keep ahead of inflation. And so inflation is always going to be a number which is less than the risk-free rate, or put a little bit more accurately, the risk-free rate will always reflect a percent return which is going to be higher than inflation. In the United States, inflation is typically around 2.5% per year, so our risk-free rate really should be something greater than 2.5%. If inflation is 2.5% and the risk-free rate is 3%, the difference between them is going to represent the amount of real return which an investor might give. If inflation is 2.5% and the risk-free rate is 3%, an investor would be getting a 0.5% real return on their money. The efficient market hypothesis is sometimes abbreviated EMH, and this is a topic that the book talks about, and I would just like to talk about market efficiency for a moment because it's appropriate here, and I'd like to try to simplify the idea for you a little bit. Market efficiency is the idea that an open market, a free market, is going to efficiently price an asset. In other words, they're going to come up with what an appropriate price would be for a particular investment. In the case of stocks, we have a lot of volume and very little interference in the market, so we have a reasonably efficient market for finding the price of an asset. But the efficient market hypothesis goes beyond that. What the efficient market hypothesis really posits is that new information is going to affect the price of an asset, and the efficiency with which a market absorbs that new information is really the measure of how efficient the market is. So the efficient market hypothesis would state that in its strongest form, in a perfect situation, all information that is knowable about a particular asset, like a share of stock, would already be reflected in its cost. In other words, there are no secrets, there are no surprises, there's no insider information. Everything that is knowable about that share of stock would already be reflected in its price, and it would be perfectly efficient in its pricing. Now we know that's not true. There are always surprise announcements. There are always unexpected events that come out. And we accept that there's a certain amount of insider trading which is possible, although illegal, in the American stock market. So we know we don't have a perfect form of the efficient market hypothesis. But it is much stronger than it was back in, say, the 1920s. In the 1920s, if you were an investor, you relied on information from your broker to get to you as efficiently as possible, or as quickly as possible, so that you could make an investment decision. Back in the 20s, information would be traveling very, very slowly from one place to another. If you were an investor who lived in, say, Los Angeles, and you were investing in stock traded on the New York Stock Exchange, you would rely on the information from the exchange to get observed by your broker in their office at the stock exchange, communicated back to their main office in New York, probably by a messenger running the information over there physically, and then that information would have to travel to the branch office in Los Angeles, and that broker would communicate with you. And a lot of that communication in those days was not done by computers or even by telephones, but it was still done by telegraph. The idea of the ticker tape machine was to put this information into as condensed a format as possible so that it could be communicated quickly by telegraph. And information from the stock exchange could be communicated back to the office and back to the investor almost immediately, or at least in the eyes of those folks in the 1920s, it was almost immediate. Nowadays, of course, if you want accurate information on the stock price, you might pull your smartphone out of your pocket and look it up in a matter of seconds. An investor who had faster access to information had an advantage because the lag time might be several days. And if you knew that a share of stock was going to go down in price over the next several days, you could take action to profit on that immediately. And therefore, the market was inefficient in its pricing of the asset. When inefficiencies occur in a market, sometimes there's an opportunity to make a low-risk profit or a riskless profit from an opportunity, and this is called arbitrage. The topic of arbitrage gets discussed in later finance courses, but it all stems from the idea of an efficient market existing.